This is Money Exchange with Andrew Barnett.
Hello, I'm Andrew Barnett and welcome to Money Exchange, Australia's first and only dedicated currency program. Over the past 3 years, the US dollar has risen sharply against its rivals as the US economy improved, unemployment declined and the US Federal Reserve stopped printing money and looked towards raising interest rates for the first time in nearly 10 years. But recently, the greenback has taken a tumble. Joining me shortly from Melbourne to discuss the US dollar's recent fall from grace is senior currency strategist at Western Union, Steven Dooley. I'll also chat with Steven about the recent rally on the Aussie dollar and if a move back lower can be expected in coming weeks. We'll cross to London, the currency capital of the world, to speak with the head of currency at Inside Investment, a company that looks after more than £383 billion. I'm starting to get the feeling the Bank of England may pull the trigger on interest rates before the US Fed, so I'm keen to get his opinion on the US dollar and British pound. IG Markets' Karen Hewenstein will help us uncover the mysteries of the virtual currency Bitcoin, and our weekly currency quiz prize has doubled this week and you could win $1,000, so stick around. Plus, we'll be answering your currency questions live on the show. You can email me directly right now, andrew@moneyexchangetv.com. Let's kick things off by taking a look at this week's currency headlines. The RBA is seeing growing risks in the commercial property market but says there are some signs of a slowdown in mortgage investor lending. That's according to our central bank's latest review of financial stability, which finds even though demand for investment property is starting to cool off in Sydney and Melbourne, lending still remains above average levels. The RBA says banks are reporting that they are becoming more wary of lending to property developers in oversupplied markets and that there's a greater risk of a downturn in the apartment market in Melbourne and Brisbane. It comes as Westpac will raise its variable mortgage rates next month as part of its efforts to help meet increased capital requirements. The bank's owner-occupier home loan variable rates will increase by 0.2 percentage points to 5.68% on November 20. Residential investment property loans will go up by the same amount to 5.95%. Westpac Consumer Bank Chief Executive George Frazis says it was a difficult decision to make and not one done lightly. Over the past 3 years, the Aussie and Kiwi dollar has lost around 30% of their value against the US dollar. The euro a similar percentage, and talk has been for the past 12 months US interest rates are about to rise. But so far, the US Fed hasn't moved, and economists are saying the runaway US dollar may start to hurt the US economy. Joining me from Melbourne is Steven Dooley, currency strategist at Western Union. Steven, has the US dollar gone too far too quickly, and can we expect to see it rise again before Christmas?
Yeah, hi Andrew, thanks for having me on. Look, I think the US dollar certainly has moved a bit too far, too fast, especially when you consider what the original move was all about. I mean, we saw a massive move in the US dollar. It was up about 25% between September last year and around about March of this year. And that was in expectation that the US Federal Reserve, as you said, was about to raise rates. And the expectation was they would probably do it in June. And if they didn't do it by June, then they would have definitely done it by September. I mean, we're here now in October. They haven't done it, and now there's more and more talk that we might not see it until next year or even the middle of 2016. So from that perspective, the reason why the US dollar moved so fast was because we thought we were going to see interest rate increases already. We haven't, and from that perspective you can see why the last month and a half has really been characterised with a big pullback in the US dollar. That initial move and the reasons behind that initial move just haven't materialised, and as a result, markets repricing that expectation. So you can clearly see why the US dollar has taken such a significant step back in the last month, now that we're, as I say, well and truly in October and haven't seen a move from the Fed yet.
So, Steven, most of the economists and traders and analysts that we talk to on the program each week are all expecting the Aussie and the Kiwi dollar to decline between now and Christmas. The Aussie back down to about 68, maybe the Kiwi to 62 against the US. Do you agree with that sentiment at the moment?
Yeah, absolutely. I think you have to, Andrew. I mean, as you say, you look at the vast batch of analyst forecasts. They're all below 70 now. And really, I think what we've seen recently has been a bit of a short-term positioning. I think the Federal Reserve will raise rates, whether it's in December, whether it's in March. I think they almost inevitably will raise rates. You look at the data that we got last night from the US, particularly their consumer price inflation, very close to the target the Federal Reserve is looking to achieve, was 1.9%, the core rate in annual terms. They're looking to achieve a 2% rate. And then you look at the other factors apart from the stronger US dollar. We've got China clearly under pressure. If you look at the big move in the Aussie dollar over the last week or so, it was that 2% fall that we saw on Tuesday after a much worse than expected number from the Chinese trade figures. We saw imports down by 17.7%, an incredible drop-off in the last year. And then apart from the stronger US dollar, apart from China, we've got our own problems in Australia, a slowing economy and expectation that the Reserve Bank of Australia might need to cut rates. And really there's a growing chorus all of a sudden that we might see a rate cut as soon as Cup Day. In that environment, those three key factors, an eventual raise in US interest rates, a slowdown in China and potential cuts in the Australian cash rate, it was almost certain to put pressure on the Australian dollar. And I think this rally is very similar to what we always see in markets. I mean, the old joke is that a 10% move lower is a correction and a 20% move is a crash. Well, in every market you see regularly see a move of around about 10% as a correction. So from that perspective, this 7% move we've seen in the Aussie to the top side can be seen as a correction in a much broader downtrend that's been in place, as you say, since the middle of 2013.
Stephen, I've got a viewer question here for you tonight on the program, and Bev is asking, with the Aussie dollar rising back higher, is now the best time to buy US dollars, or will the Aussie rise further? I think you've just answered her question that we're probably likely to see it fall between now and Christmas.
Look, that's the number one question that you get constantly with people about to go overseas. But I think there's no way of certain of knowing what's happening in markets, whether it's the best level. You have to sort of get an idea, I think, about what level you are looking to achieve, and if that's better than the level you're looking to achieve, then you have to be happy with that. I think you just have to go back and have a look what the broad forecast is across the market. There's no one single expert, but you have a look. The vast majority of analysts expect the Aussie dollar to be under pressure over the next 1, 3, 12 months. And so from that perspective, this big rally we've seen, this almost 10% rally, looks like a gift for those who are travelling overseas, especially when you consider 2 or 3 weeks ago they would have been looking at transacting around about 68 cents. If they can get a level around 73 cents, that's a great result for them.
Stephen, thanks so much for your time this evening. I really appreciate it.
No problem. Thanks a lot for having me, Andrew.
After the break, we'll cross to London to find out what's driving currency markets in the UK and Europe. Don't go away.